If you think retirement is about hitting one magical number, you've already misunderstood the game. Most people believe there's a single finish line. One clean, round number where everything suddenly becomes safe. $1 million, 2 million. Maybe some number a financial guru threw around on a podcast. But here's what almost nobody tells you. Retirement strategy doesn't shift at one number. It shifts in stages. And if you don't recognize the first shift when it happens, you'll build wealth the wrong way for years. We're conditioned to think linearly. Save $10,000, you're $10,000 closer. Save $100,000, you're 10% of the way to $1 million. Simple math, clean logic. Except wealth doesn't grow in straight lines. It grows in force, and that force changes how you should behave long before you hit 7 figures. The first wealth level, what I call foundation capital, sits roughly between $100,000 and $250,000 in invested assets. This is not retirement money. This is not financial freedom. This is not passive income replacing your job. This is something more important. This is the point where your strategy starts to matter more than your savings rate. Below $100,000, everything depends on you. Your contributions dominate the equation. If you're investing $1,000 a month, that's $12,000 a year. On a $40,000 portfolio, even a strong 10% return only generates $4,000. You are the engine. The market is a small assistant, but cross into 6 figures and something subtle begins to shift. At $150,000 invested, a 7% return produces $10,500 in growth. At $200,000, that same return generates $14,000. Now your money is adding more than an entire extra monthly contribution, without you doing anything different. It doesn't feel dramatic. It doesn't make headlines. But mathematically, this is the first inflection point. And here's where most people get it wrong. When portfolios are small, volatility feels terrifying. A 20% drop on $80,000 wipes out $16,000. That's more than a year of contributions for many investors. Emotionally, it feels like starting over. So people panic. They reduce risk too early. They shift conservative. They interrupt compounding. But at the foundation capital level, the correct strategy is the opposite. This stage demands aggression, not recklessness, but disciplined growth. Your retirement timeline is still far enough away that volatility is an ally. Down markets are not threats, they are inventory sales. When your account dips, your contributions buy more shares. Recovery periods amplify future growth. The longer your time horizon, the more valuable instability becomes. This is the stage where income growth matters more than asset allocation tweaks. An extra $5,000 per year invested in your 30s compounds into multiples over decades. But shaving 0.2% in fees won't move the needle nearly as much as increasing your earning power. At foundation capital, your career is still your largest asset. Skill expansion, promotions, side income. These are not lifestyle upgrades. They are retirement accelerators. Psychologically, though, this stage is brutal. Your account feels too big to ignore, but too small to relax. You've proven you can save, but you haven't yet felt financial momentum. You check balances. You calculate timelines. You wonder if you're behind. Here's the truth. This discomfort is structural. You're in the transition zone where compounding is warming up, but hasn't taken control yet. The growth curve hasn't steepened. You're pushing the boulder uphill. It's moving, but gravity still works against you. And that's why this level changes strategy. Before 6 figures, retirement is abstract. After you cross into foundation capital, retirement becomes measurable. You can run projections that produce real numbers. You can estimate future value. You can model scenarios. At $200,000 invested, earning 7%, without adding another dollar, that capital doubles roughly every 10 years. With continued contributions, the timeline shortens dramatically. This is the first moment you realize something critical. Time is now more powerful than effort. Not more powerful than discipline, but more powerful than intensity. You don't need extreme returns. You need consistency. You don't need exotic investments. You need scale. And scale begins here. The first wealth level isn't about being rich. It's about crossing the threshold where money starts to exhibit mass. where it begins to generate meaningful gravitational pull. You're still working for money, but for the first time, money is quietly starting to work in proportion to you. Most people stop pushing here. They plateau. They increase lifestyle instead of capital. They mistake progress for arrival. The second wealth level is where retirement stops being a distant concept and starts becoming a controllable variable. This stage typically sits between $500,000 and $750,000 in invested assets. And the shift here is not emotional, it's mechanical. At $600,000 invested, earning a conservative 7%, your portfolio generates $42,000 per year in growth. That's not theoretical. That's not a projection 40 years from now. That's what the math does in a normal year. Pause and process that. If you're still contributing $15,000 or even $20,000 annually, the market is now contributing more than you are. Your role in the equation is shrinking. Capital is becoming the primary driver. This is strategic control capital. Below this level, your strategy revolves around accumulation. Maximize contributions. Increase income. Stay aggressive. Ignore noise. At this level, your strategy must evolve, because risk behaves differently when your base is larger. A 20% correction on a $600,000 portfolio erases $120,000 on paper. That number looks violent. But here's the part most investors miss. By the time you reach this stage, your portfolio has likely already experienced multiple drawdowns and recoveries. You've seen the cycle, you understand the pattern. Volatility becomes less of a threat and more of a timing factor. And this is where retirement flexibility begins to appear. Using a conservative 4% withdrawal framework, $600,000 supports roughly $24,000 per year. Alone, that may not fund your lifestyle, but combined with part-time income, rental cash flow, or a spouse's earnings, it changes the equation. Retirement is no longer binary, working or not working. It becomes elastic. You can reduce hours, you can shift careers, you can walk away from toxic environments, you can take calculated professional risks. This is the first time optionality enters the system. Optionality is the hidden metric of wealth. At $100,000, you have progress. At $600,000, you have leverage. And leverage changes behavior. Instead of obsessing over maximizing return, you begin thinking about protecting trajectory. Asset allocation starts to matter more. Tax efficiency starts to matter more. The structure of your accounts, Roth, traditional, brokerage, now meaningfully affects long-term outcome, because now mistakes compound too. At foundation capital, a bad year delays you. At strategic control capital, structural inefficiency can cost six figures over time. This is why the second wealth level requires strategic refinement. You begin thinking about sequence of returns risk, the danger of withdrawing during early market downturns. You model what happens if retirement begins in a bear market. You analyze how much fixed income stabilizes volatility versus how much equity fuels continued growth. The conversation shifts from, how do I grow, to, how do I balance growth and durability? Psychologically, this stage feels different. The anxiety of being behind begins to fade. You can project realistic retirement ages with credible confidence. You're no longer guessing, you're calculating. And something subtle happens here. You stop thinking in terms of decades. When your portfolio grows by $40,000 in a year without lifestyle changes, you begin to see time differently. A single strong market year can accelerate retirement by 1 or 2 years. A few disciplined years of continued investing can compress timelines dramatically. Momentum is visible, but this is also the most dangerous plateau, because lifestyle creep becomes seductive right here. Income is likely higher now. Assets are substantial. It feels reasonable to upgrade homes, cars, vacations, and some of that is earned. But here's the strategic danger. Every permanent increase in lifestyle raises your required retirement number. If you need $60,000 annually to retire, $600,000 feels like progress. If you inflate lifestyle to $100,000 annually, the target shifts toward $2.5 million, using the same withdrawal assumptions. At this level, your spending decisions directly reshape your retirement horizon. That's why strategic control capital isn't about feeling rich. The third wealth level is where retirement stops being a projection and becomes a controllable event. This stage typically begins around $1.5 million and extends beyond $2 million in invested assets. And the shift here is absolute. At $1.5 million invested, earning 6 to 7% annually, your portfolio generates roughly $90,000 to $105,000 per year in growth during normal market conditions. At $2 million, that same return produces $120,000 to $140,000 annually. That's not accumulation anymore. That's financial mass. Using a conservative 4% withdrawal framework, $1.5 million supports $60,000 per year. At $2 million, you're looking at $80,000 annually, without touching principal in long-term historical models. This is where retirement becomes optional, not symbolic, not theoretical, optional. At this level, your strategy changes again. You are no longer primarily optimizing for maximum growth. You are optimizing for durability, efficiency, and sequence management. Sequence of returns risk, the danger of retiring into a downturn, becomes the dominant variable. A severe bear market early in retirement can permanently impair portfolios if withdrawals are inflexible. So strategy adapts. Cash buffers increase, bond allocations are recalibrated. Withdrawal strategies become dynamic instead of fixed. Tax sequencing becomes deliberate, drawing from taxable accounts first, allowing tax-advantaged assets to compound longer. The conversation shifts from "how much can this grow?" to "how resilient is this structure?" And here's the critical insight. At this level, your portfolio can continue growing even while you withdraw from it. If you withdraw 4% from a $2 million portfolio, $80,000, but the market returns 7%, $140,000, your assets still increase by $60,000 in that year. You are living off growth, not depletion. This is the psychological turning point. For decades, retirement planning felt like stockpiling resources for a long winter. Now it feels like owning a productive asset that continues generating surplus. Work becomes elective. You might still choose to work. Many do. But the motivation shifts from necessity to preference. You negotiate differently. You tolerate less. You design more. And here's something rarely discussed. Risk tolerance often increases again at this stage, but strategically. When you need $80,000 per year and your portfolio generates $120,000 in a typical year, you have surplus growth. That surplus can be allocated towards slightly higher return assets, private investments, real estate, or philanthropic ventures without jeopardizing baseline security. Not recklessness, margin. Margin creates confidence, and confidence changes everything. You no longer view market corrections as existential threats. A 20% drop on $2 million reduces the portfolio to $1.6 million. Uncomfortable, yes. But even at that reduced level, a 4% withdrawal still supports $64,000 annually. Combined with Social Security or other income streams, retirement viability remains intact. This is the first time volatility loses its emotional edge, because your financial structure is now self-sustaining. And this is where most people misunderstand wealth. They believe the goal is hitting a round number, but the real objective is reaching escape velocity, the point where capital generates enough internal growth to fund life while continuing to exist. Below $1 million, you are accelerating. Between $1 million and $2 million, you are stabilizing. Above $2 million, you are managing optionality. This level also introduces legacy thinking. When your portfolio reliably generates more than you spend, excess capital accumulates automatically. Estate planning becomes relevant. Trust structures, charitable vehicles, generational transfers, these aren't luxury topics. They become rational considerations. Because now the question isn't, will I run out of money? It becomes, here's the shift nobody talks about. It's not the numbers themselves that change your retirement strategy. It's how each level alters your relationship with time. At Foundation Capital, $100,000 to $250,000, time is your weapon. You need it. You rely on it. Your strategy is built around feeding the machine and letting decades do the heavy lifting. Risk is acceptable because you can recover. Volatility is fuel. Your job is to stay aggressive, stay invested, and keep increasing inputs. You are building mass. At Strategic Control Capital, $500,000 to $750,000, time becomes leverage. You no longer just need years. You can compress them. Strong market cycles move retirement forward meaningfully. A 5-year window can create 6-figure acceleration. Risk becomes something you calibrate, not simply tolerate. You begin protecting downside because losses now have visible consequences. You are steering mass. At Financial Independence Capital, $1.5 million and beyond, time stops being a requirement. It becomes a preference. You don't need another decade to make it work. You don't need heroic returns. The math is already viable. Every additional year worked increases margin, not survival probability, and that changes your psychology in ways most people underestimate. When retirement depends on time, you feel pressure. When retirement depends on mass, you feel control. Look at the contrast clearly. At $200,000 invested, earning 7%, your portfolio generates $14,000 annually. Helpful, but not life-changing. A bad year delays you. A job loss threatens trajectory. Time is fragile. At $600,000, earning 7%, you generate $42,000 annually. That income alone can cover major expenses. You can survive transitions. You can negotiate. Time starts bending in your favor. At $2 million, earning 6 to 7%, you generate $120,000 to $140,000 annually in average conditions. Even if you withdraw $80,000, capital can still grow. Time is no longer something you chase. It compounds quietly behind you. This is the real shift. Below the first level, retirement feels distant. Between the first and second, retirement feels possible. Beyond the third, retirement becomes a decision you schedule. And here's the part that reframes everything. Retirement was never about age. It was about financial mass relative to lifestyle demand. Two people can both be 60 years old. One has $300,000 saved and needs $90,000 per year to live. Retirement is mathematically unstable. The other has $1.8 million and needs $70,000 annually. Retirement is structurally sound. Age didn't decide the outcome. Capital structure did. This is why lifestyle inflation is the hidden variable in every strategy. At Foundation Capital, raising lifestyle slows acceleration. At Strategic Control Capital, raising lifestyle pushes the independence threshold further away. At Financial Independence Capital, raising lifestyle determines whether capital grows or stagnates. Your required income defines your required mass. And that brings us to the final clarity. Wealth is not the number in isolation. Wealth is the ratio between what your capital produces and what your life consumes. When production exceeds consumption consistently, freedom emerges. When consumption outruns production, pressure returns, regardless of net worth. That's the real reason these 3 levels shift retirement strategy. Each level changes the balance between production and demand. Each level changes how much margin you have. Each level changes whether time is your master or your tool. Most people chase a round number because it sounds impressive. But sophisticated retirement planning doesn't chase round numbers. It builds towards structural independence, and once you reach the level where your capital reliably produces more than your life requires, retirement stops being an end goal. It becomes optional space. Optional to work, optional to stop, optional to scale back, optional to redesign. That is the final shift, not from poor to rich, not from working to retired, but from dependent on time to independent of it.